Welcome to everyone in attendance today. Glad you could join us. My name is Nick Emerson, real estate broker and owner of the Emerson Group here in San Diego with Keller Williams. I'm proud to introduce our guest speaker, Nick Schoch. Nick has over 15 years of experience in the lending field, of which 14 were spent with a large regional bank and working with clients ranging from large-scale developers who are building retail and shopping centers to clients buying their first apartment building. So he's got a wealth of knowledge and many different layers of financing. And before handing over to Nick, I also wanted to mention to please submit any questions in the question box that you might have as they come up. And Nick or myself will make certain to answer them throughout the presentation. If it's a specific question not pertaining to a certain slide, please leave those for the end of the presentation. So without further ado, Nick, I'll let you take it off from here.
All right, thanks. Can you hear me?
Yep.
Excellent. Yeah, so thanks for the introduction, Nick. As mentioned, I'm a commercial mortgage broker, so my specialty is helping investors find financing for commercial real estate, which means properties that are 5+ units in the residential space and retail, industrial, and office projects. If we could kick it up to the next slide. So this is my intro that Nick covered fairly well. One takeaway is that I have a website that has articles I've published in some of the local trade magazines that may be interesting, but we can move forward after this. So why are you here? Why do we want to discuss commercial loans? And I think the quick and easy answer is to expand your investment opportunities, especially in a low inventory market like we're seeing today, where not many people are listing their properties, and the ones that are being listed have a lot of bidders. So, right now your scope is 1 to 4 unit residential. You can get a lot more opportunities if you start looking beyond that into the 5+ unit multifamily or even to non-residential properties. So when do you need a commercial loan? This is something I touched on a little bit earlier based on, what I do. My focus is purely commercial. I don't do 1 to 4 unit investing opportunities, but I do commercial. And so what is a commercial opportunity? That's a residential property with 5 or more units, or a non-residential property, which could be, again, retail, industrial, office, cold storage, anything else besides the 1 to 4 unit residential space. So I'm going to assume that everybody on the call is familiar with a conventional mortgage. Think of something you would get on your house or on a 1 to 4 unit residential property. So I'm going to compare a commercial loan to a conventional mortgage and talk about the differences therein. Let's start with loan sizing. So on residential, again, it's very borrower focused, which means that, yeah, they're looking at the property's loan to value, but they're really focused on your personal debt to income ratio. So they're going to look at your W-2 income and any investment income to help justify the mortgage, making sure that you can make the payment on that new mortgage. Whereas in commercial, it's property focused. So yeah, loan to value remains a factor, but the lender is more concerned with the property's cash flow and its ability to pay the debt service for the mortgage. Something that is worth noting on that is for investors who are retired, because the lenders in the commercial space don't focus on W-2 income as much, it can be advantageous to invest in commercial because of the fact that you can finance properties more easily because the lenders focus on that property cash flow rather than your W-2 income, which if you're retired, you don't have any. So again, it's an advantage to commercial is that if you're retired, your properties can support their own underwriting versus in the residential smaller space, you need income generally to support your investments.
Perfect. I just wanted to jump in and just add to that, just acknowledge that that's a huge benefit that a lot of our clients that are in retirement or planning out want to be able to create an estate that is simple and straightforward. And so if they have the ability to roll several properties into a larger asset, we'll get into that. But allows them to simplify, which is typically that goal in that space there, but also allows other people that maybe you're, a CEO or business owner and you're intentionally writing down the income in the business. You're not going to get as dinged or discredited for getting a loan as you would observe in the traditional space.
Thanks, Nick. Yeah, so lender types, in the conventional space, you're used to dealing with a bank, sometimes a broker, or your credit union, and all those loans are generally backed by Fannie or Freddie, or what we call the agencies. In the commercial space, however, it's different. There's all different types of lenders, and each lender has their own likes and dislikes in terms of what types of properties they like to lend on and what types of loan terms they typically extend. So it's like residential, but there's vast differences in the loan terms. There's some other lenders that play in this space, especially for larger properties. You may have heard of CMBS or commercial mortgage-backed securities. There's also insurance companies, funds, and hard money. But again, the focus for most people investing in apartments or even retail industrial office is going to be the banks, credit unions, and the agency lenders for multifamily. So what other qualifications are different? In residential, it helps if you live in the property. If it's an investor property, you've probably experienced it where the lender adds 25 to 50 basis points to the rate. If you invest through an LLC or a single purpose entity like a partnership, it can be a problem for the loan. Again, this is because it's meant for homeowners. If you go into commercial, this is naturally intended for investors, which means that owner occupancy can actually be a detriment to financing. Some lenders will require LLCs, and the lender will sometimes focus on the sponsor's wherewithal outside of the property, specifically the net worth and liquidity. So that's something you're probably not used to seeing on the residential side. So they generally size up, you based on your debt to income, like we mentioned earlier. They'll look at your credit score, but they don't really look at net worth as a big contributor. Whereas on the commercial side, it is a factor. So again, big takeaway, commercial is meant for investors, residential is meant for homeowners. So, you're looking at commercial, and like I mentioned earlier, there's a wide spread of property types. For most investors, they kind of make the step up from a 1 to 4 unit residential property. So it's pretty natural that they'll move into the multifamily space, which is defined as 5 units or more. Once you're looking for loans, it helps that the loan is larger. In commercial, if it's below $1 million, the number of lenders interested in lending on that property goes down significantly. That said, there are people that will lend, it's just fewer. Next up is manufactured housing communities. The more colloquial term is mobile home parks, then industrial, office, and retail. The idea being that multifamily has the most lenders, it's the easiest to get a loan done, and that's because the risk profile it's low risk versus the other property types. So some other big differences you should be aware of, in terms of structure. We should start with the fixed rate period. If you're used to conventional residential financing, it's 30-year mortgages. That's the standard, right? Longer. Commercial is shorter generally. You're going to get what is basically an adjustable rate mortgage structure typically that ranges from 3 to 10 years fixed. Many loans have terms longer than the fixed rate period, which means that it's going to adjust thereafter with that adjustment feature. This means you're going to have to refinance your properties regularly, at least every 5 to 10 years. So the next one is long term. So as I alluded to earlier, residential 30 years, pretty standard, it's longer. Commercial is shorter. You're going to get 10 to 20 years most often, and 30 years is available for multifamily. So again, this is going to require regular refinancing, but at the end of the day, it's important to keep in mind that if you need the additional term so you can float, if say the market freezes up or it's 2008 and lenders step out of the market, you will generally have an adjustable period that allows you to not worry about some bullet maturity with a big payment due, but instead just make your regular payments on a floating rate basis, and it gives you time to look for a refinancing option. So lastly, of the period structural pieces, as I would call them, amortization. With residential, it's again longer. It's that conventional mortgage you're all used to where it's 30-year term, 30-year fixed, with a 30-year amortization, which means the loan fully amortizes. So after 30 years, you'll be making that last payment and it pays off the loan. There's no bullet, there's no balloon payment, as it were. Commercial is often shorter. So they'll have 25-year amortizations. 30 years is available for multifamily, lower risk loans. But what does this mean for you as an investor? It means less cash flow, right? Because you're building your equity in that property faster by making larger principal payments every month. This is a big one, prepayment premiums. In residential, you may not be familiar with this because generally there are no prepayment premiums. In the commercial space, there's almost always a prepayment premium. And these range from two basic types. Sometimes there's a blend or a combination of them, but basically there's either yield maintenance, which is the old school way of calculating a prepay. What that means is if you go to pay off your loan when interest rates go down, your prepayment premium or the penalty you pay will be greater, because effectively what's happening is the lender has to go out in the market and replace the loan that you're paying off. And because rates are lower, that means their opportunity cost is higher for your payoff, which means you have to pay them more. It's basically a formula that makes sure that they are indifferent whether or not you pay off a loan, because you're making them whole by making a big payment. It's kind of complicated. It's one of those things where you have to put together an Excel sheet to calculate what it is, and it's pretty arduous. On the other hand, the declining step-down schedule. This has become more common over the last 15 or 20 years, where you have a predefined prepayment premium. So, for a 5-year fixed rate deal, a common step-down schedule is 5% in year 1, 4% in year 2, 3% in year 3, and so on, until there's no more prepayment after the end of your fixed rate period. This is nice because you know exactly what your prepayment penalty will be at any point in time. So in theory, if you finance your property at 5%, and you have, it was 4 years ago, you have 1% left on your prepay, but rates have gone down to 3.25%, it might make sense to pay that prepay to refinance right now. So again, the big takeaway here is be aware that there are prepayment premiums almost always in a commercial loan structure, and it's important that you consider it in your investment strategy. Obviously, you don't want to sign up for a long prepayment schedule if you plan to sell the property in 3 or 4 years, for example.
One of the things I wanted to point out on this topic in particular is this is a great example of you're going to need to be working with someone who can consult with you and educate you through the life of the loan, so that you're making the appropriate changes in refinancing structures based on what the market's willing to offer you. And naturally, there's a lot of options in the commercial space, and the terms become and the details become that much more critical. Also, I wanted to ask Nick, what does a typical prepayment look like? What kind of expense are we talking about here on a typical prepayment on, say, $1 million loan?
Yeah, it's a good question. With the step-down prepay, it's pretty straightforward, right? If it's 1% on $1 million loan, you can do the math on that. It's going to be like $10,000. But if it's a yield maintenance, it can be deceivingly high. So, for example, I have a client right now that's been wanting to refinance their loan for over a year because rates are low and they're tired of the lender they're working with. However, they're in a yield maintenance prepayment premium structure. And as rates have been going down, the amount's been increasing. And in their case, the amount is about $50,000 on a $500,000 loan. So you can see 10% is effectively the prepay that they would be having to pay right now, which is so high that there's no way they would ever consider paying that. And they're kind of stuck where they're at. Whereas had they chosen a declining step down, they'd be well out of that prepayment premium, and they could pay off a loan anytime they wanted with no penalty.
So this would kind of be part of the consultation with the client, right, where you would assess what is the big picture, what's the goal of the asset, what does the ideal holding period look like, and or are there any changes or improvements that are going to be made, kind of what the overall plan is, so that you can consult them on which term and structure makes the most sense for them.
Yeah, absolutely. If I know, again, that this is kind of a fix and flip strategy where effectively you want to buy the property and hold it for a short period of time, like let's say, reposition over 3 years, I'm not going to advise they move into a structure where there's a prepayment premium that takes 5 years to burn off. I mean, it's very subjective based on the individual investor's investment horizon and strategy. So it does help to have another person to bounce these ideas off of before you commit to some lender's structure. Okay, so other differences, recourse or guarantees. Residential, these loans are all non-recourse by default. And recourse, means effectively, will you be on the hook if the lender, the loan goes into default, The lender forecloses and they sell the property. If they sell the property and it doesn't discharge or pay off the outstanding balance, this was a problem back in 2008 when property values plummeted, the lender has a deficiency. Now, by default, a consumer mortgage or residential mortgage is non-recourse, which means the lender can't come after you for that deficiency. In commercial, it's often recourse, especially when you work with a bank or a credit union. So what that means is that if the loan goes bad, they're going to expect you to make them whole. Not without getting into the details and going beyond my expertise into the legal field, generally this hasn't been really monetized too much in the sense that banks haven't really taken people to the mat by non-judicially foreclosing or judicially foreclosing and going after people for their assets to pay off the loan. But it's just something to keep in mind. Generally, the reason why most people will sign recourse is because there's a rate discount associated with that, whereas lenders will charge up or add to your interest rate or decrease the amount of loan dollars you can get, decrease your loan to value, increase your minimum debt coverage ratio to size your loan if you do sign up for non-recourse. So that's kind of the trade-off. The lenders see non-recourse as higher risk, which in theory it is, and they'll either charge you for it or size the loan such that it's lower risk to offset. So reporting, this is another one that might be new for investors who are typically in the 1 to 4 unit space. In commercial, there's reporting, which means that the lender wants to see, property performance on typically an annual basis. And what that means is you will need to submit as the borrower a rent roll and a trailing 12-month operating statement that shows the performance of the property and its current occupancy, generally at least once a year, though the lender has the right to collect or request more if they think the property's, higher risk or something's going on. So big picture, residential, no reporting, commercial, more reporting. And, what that means is generally the reason why they're asking for this is because they want to assess what's going on with the property and risk rate the loan for their books. So for most people, it won't be a problem. It's just one more thing that you have to do once a year.
Nick, would there be any form of consequence, or what would happen if there was reporting that was deemed bad, or the integrity of the reporting was questioned? What would that look like?
So if you had bad news to share with the lender, like the reporting period comes up, it's been the anniversary of the loan, so you closed it a year ago and they're asking for your rent roll and operating statement, and for some reason 2 units were vacant, most of the time they can't do very much unless there's some kind of trigger in the loan documents, like a debt service coverage ratio test to make sure that your property cash flow is at least 1.2 times the debt service. Most of the time, multifamily loans don't have those kinds of covenants. And even when they do, so long as you're making your mortgage payments, the lender really can't do much on a non-monetary default. It's typically a non-issue. Where it can get more complicated is, say you decided to reposition the property or remodel the property and empty out all the units. They find out at that point, they could make an argument that you're not managing the property appropriately. They could enact a default rate, which would be a 5% addition to your existing rate generally. They can make your life difficult, but for the most part, it's really just kind of for them checking a box and moving on. I mean, it depends on the lender. That's where it helps to have some expertise in selecting your lender, is knowing who is more exacting or more difficult to work with on regular reporting versus others that, kind of just, again, check the box. Does that answer your question?
Yeah, and to put this into context for everyone, how many oftentimes out of 100 cases where there actually be something where there would be a call to action for the reporting?
Having monitored a portfolio of about 2,000 loans in a past life as a banker, we maybe had 1 out of 100 in a given reporting cycle where we had to take another action. And it generally just consisted of, hey, this statement doesn't make sense, or, instead of sending it with construction paper and crayons, can you actually print out a computer generated rent roll? Reporting quality varies, right? Just naturally.
Perfect. The other thing I wanted to ask too before we switch sides is, what happens if the borrower passes away? Does the lender typically call the note due?
Good question. Oftentimes the lender doesn't know. If they do find out and you didn't tell them, they may be a little bit bothered by that. But for the most part, the short answer is their documents provide them the right to call the loan generally. They don't tend to do that, provided you keep making payments. The lender will want to be assured that the successor interest the heirs of the person the decedent has the wherewithal to continue supporting the loan. Because for them, they want to make sure they're going to keep getting paid, right? So if they see it's being mismanaged, they want to be able to take action. So, as a broker and advisor, I generally talk to my clients and make sure that if that's a concern for them, we talk to the lender to get special language put in there, which simply says there's no default provided it goes to these identified heirs. So it stays within the family and management's in place that they can trust. That way it kind of, allows them to rest at ease knowing if they get hit by the bus or an untimely death, or even in some cases they're old and they know in the next 10 years, there's a good chance that they'll pass before the loan comes due. They want to make sure that their heirs don't have more problems than they already have, mourning the loss of a loved one.
Perfect. Thanks for extra detail on that. Sounds
Sure.
good. Anyone else have any other questions about anything just before we jump into the next thing, just to make sure? So a reminder, feel free to ask any questions in the chat box there. We'll be happy to entertain them. Nick would be happy to answer them. So, all right, moving on.
So loan brokers, this is people in my role. Residential brokers are generally fairly transparent. They're highly regulated. Their involvement generally doesn't affect the rate the banks or lenders pay them, and it's built into the product. On the commercial side, you need to be more cautious. It's not as regulated. You, as the investor, generally pay the broker at closing. It's kind of, the fee structure varies depending on the loan. I generally charge 1%. Some people charge more for construction or if it's a smaller loan. And the big thing to keep in mind is that some lenders will pay rebates or referral payments to brokers, and they won't disclose it or it won't be obvious to the investor. So, what that could mean is that you're going to pay your broker 1% without realizing that the lender paid him another 50 basis points or 0.5%. And at first you might be like, okay, that's kind of lame that I don't know that he's getting extra money. But the real thing is that money doesn't come out of thin air. The lender's not being generous. They're charging you, the investor, more by pricing that into the loan rate. So effectively your rate would be higher. That's why it's important to ask these questions of your broker and or your lender. Make sure, because they will disclose it if they're asked. A few people are that, immoral, but you just have to be aware that this is a thing and make sure to ask, whether the rate includes any kind of, what they call a premium for the broker. The other thing to keep in mind is that, you just have to ask your brokers, make sure that their pricing is par, which means there's no fee built in or no payment to the broker. That's the big question. So be cautious. So a big question for many investors is, can I exchange into commercial? And the short answer to that is yes. Obviously I'm not an attorney or an accountant, but it's generally well known in the industry that 1 to 4 unit investments are like kind to multifamily, retail, industrial, office investments. As long as it's investment real estate, whether it was small units or large, you can, move into that space. I see a question in the chat. Average or typical net worth for a loan less than $1 million or $5 million. Is there a minimum percentage net worth to loan? Yeah, that depends on the lender. So for example, the agencies generally have a requirement that your net worth be equal to the loan amount, for example. That said, I found, if I have a situation where, I'll without naming names, I have one specific client where they were exchanging from one 5-unit property to another 5-unit property. It was the only investment they had, and they lived off Social Security income. This is obviously a situation where if it was a 1 to 4 unit, they wouldn't have qualified for traditional conventional financing. His net worth was substantially lower than the loan amount, just by the nature of his acquisition being greater than 50% loan to value, and he didn't have any other assets beside the property. So there are exceptions, and you can get, you can have a lower loan amount and get a loan that may exceed the expectation based on other lenders. I hope that answers your question. If not, we'll follow up at the end. So getting back to an example, let's talk about this, right? So you've decided you're shopping for a new investment and you're debating, should I buy another 1 to 4 unit property or exchange into a larger property? Stacking up some of the benefits, obviously I focus on commercial. I'm going to freely admit that I'm a little bit biased here, but on the 1 to 4 side, the process, You get that convenient 30-year fully fixed mortgage, very straightforward. Can refinance it whenever rates go down. It's great. Where you might run into problems and where commercial starts making more sense is if your income is not as clear cut as they like to underwrite on the residential side. So you have just Social Security income, you have a tax return where you have a lot of taxable income is below zero or close to zero, but you have good cash flow because of depreciation. That's when it starts making more sense moving into commercial, where people are used to underwriting those circumstances, and you're not facing any kind of loan count limits. I mean, Fannie, once you get past 5 or 6 loans for investor property, they either start increasing rate or decreasing your leverage, reducing your effective loan proceeds. The other upside that Nick had mentioned earlier was a simplified estate. I mean, you go from potentially having 30 units spread across or 40 units spread across 10 properties to potentially 1 or 2 properties. It's obviously a lot more simple to explain and manage, right? And that kind of leads us to the next idea, which is higher returns. So that's obviously a very alluring concept, making more money for what you invest, right? So where does this higher return concept come from? And the answer is economies of scale. So what do I mean by economies of scale? It's much easier to manage one big property than it is to manage multiple properties for the same number of units. And that's also reflected when you go to price out property management. So if you go to a property manager and say, hey, I have a 4 or 5 unit to manage, you're going to be paying somewhere in the ballpark of 8 to 10% of that income, if not more. Whereas if you had, say, a 300 unit complex, you could be as low as 3%. And generally, once you start getting to 5 to 10 units, you're starting to look at 6 to 7%. So you can see it slowly starts to move down as you have more units at a given property for management. So that's the same idea if you're managing yourself. There's a reason why they're not charging you as much, because it's easier to manage more units in one place. Another big example of a benefit of economies of scale is, a single vacancy doesn't cost you, 25 to 50% of your cash flow. If you have 4 units, someone moves out and you need to redo that unit, that's 25% of your units offline. So you might have plenty of cash and maybe it's not a big deal, but if you have a partner and you have a special purpose entity holding that property, you're going to have a debt service payment or a mortgage payment that month, maybe some other maintenance requirements where you might have to inject capital into that entity to make that month's payments. So if you have a larger property, obviously that's not as big a deal. Instead of 25%, if you have a 10-unit property and 1 unit goes offline, you're talking 10% of your income, which isn't nearly as volatile. Moving on, fewer roofs to fix. That seems pretty obvious, right? I mean, you have 1 big apartment building, maybe 2 buildings next to each other. It's 1 roof quote versus potentially 4 or 5 for the same number of units, all spread out in a 1 to 4 unit kind of property arrangement. So you're going to get a better deal. It's going to cost you less per square foot of roof repair or replacement. Fewer insurance policies. I mean, they get economies. The insurance company gets economies of scale as well for doing 1 policy as opposed to having to underwrite 10 policies or 4 policies, and they kind of pass that on in the form of lower premiums. Fewer loans to negotiate. So you obviously 1 property versus 4, you're not having to deal with, if rates go down, you need to refinance, you're only having to deal with 1 transaction versus 4, fewer documents to sign, negotiate, et cetera. Now that has to be offset slightly by the fact that, as I mentioned earlier, commercial generally requires refinancing a little more regularly, say every 5 to 10 years, versus residential, in theory, you could set it and forget it. So with that, I put together this appendix, which kind of summarizes the differences we've talked about thus far and could be a good jumping off point for some questions. With that, I'll pass it back to Nick.
Awesome. Thanks, Nick. Yeah, so as far as any questions go, whether it's a specific scenario, a question about something we talked about, or maybe just a question about something we didn't touch on, we'll definitely leave it open right now to submit any questions you might have from what we went over. And obviously, we do want to build upon this and go deeper if there's a certain segment that you want to really get more clarity on or more details. So please share any questions that you might have. And if there is no questions, we appreciate your participation and trust that you found value in this presentation. And naturally, Nick is available to conduct one-on-one calls if you want to go over a specific scenario for yourself, or even if you'd like to, kind of review your current commercial loan and evaluate options in the current marketplace based on where rates are at. So with that being said, is there any questions out there? Anyone have any things they would like to get some feedback on or just simply go over? All right, Kelly's typing.
Question now.
Go on. This might seem like an obvious question, but Nick, why is it that there's such a smaller holding period for commercial loans versus residential?
That could be a long answer, but the short answer is that banks hold these loans on their balance sheets generally, with the exception being the Fannie and agency loans. So banks want the ability to turn their capital over. So to be fair, they issue these with 30-year terms oftentimes, but with a shorter fixed rate period, with the idea being that they want a shorter weighted average life. So it's getting kind of complicated, the bank finance side of it, but it makes sure that they're churning it regularly. The other aspect to that is the cost of 30-year fixed rate funds is generally fairly high, especially for a bank, because for them to lock in a rate today at 3.5 for 30 years means they won't be able to invest that money into another loan if in 10 years rates move up to 5 or 6%, right? Because obviously they'd like that 5 to 6% money. So by having their loans churn more regularly, they don't miss out on a higher interest rate environment opportunity. But getting back to residential, the agencies were set up with some of the New Deal economics back in the early 20th century, with the idea being instead of everybody having to finance their homes on these 5 to 10 year loans that just are interest only and they have to refinance every 5 to 10 years, they could get a 30-year simple mortgage where as long as they made their payments, they had their house free and clear after 30 years.
Yeah, well, it made sense what you said, right? They don't, in the residential side, Fannie and Freddie provide the liquidity in the secondary market for lenders, right? So they can, lenders can keep lending because they don't need to have all the capital in-house. Whereas on the commercial side, these banks are holding the notes. So they're originating them, they're the direct lender, and they're holding them. They don't have a secondary market per se to be able to recoup that liquidity and reloan again.
Yeah, that's right. I mean, the 30-year mortgage market for residential, the risk profile of a residential property loan has a proven market with Fannie and Freddie, right? Fannie and Freddie play in the commercial space as well with multifamily, but the securities market that they're selling into there has a preference for that, shorter term fixed rate obligation, not 30 years. That said, getting into detail and complexity, there are 30-year fully fixed multifamily loans offered by the FHA. They're pretty arduous to get done. So it generally makes sense in a super low rate environment like today for a larger property where you just want to set it and forget it. But again, if you're a commercial investor, you're not looking, most investors aren't looking for, a loan where they pay off the loan. They're looking for, cash flow, and they're looking for leverage so they can maximize their returns. Now, obviously there's a balance there, but a lot of investors, if they had a fully fixed 30-year, they'd be refinancing every 5 to 10 years to take out equity to buy more property. So it doesn't really make sense to pay that premium for them to lock it up for 30 years. Does that make sense?
Right. Yep.
Looks like we have some questions.
Yeah, so Kelly's question is, are there 1031 exchange opportunities? If I have one unit, can I roll the sale into a commercial property?
Yeah, the short answer to that is going to be yes. Again, not a tax advisor or a lawyer here, but generally if you've held the property, even if it's a single unit for investment, so it's been rented out, you can occupy it as personal residence, you can sell that property, identify a new property within 45 days, and then close the purchase of the exchange property within 180 days of the sale of the other property, the original property. So that would allow you to make that roll, as it were, into a commercial property. Does that make sense?
Perfect. Kelly, if you have any follow-up questions on that, awesome. Cool. Question from Portia. When it comes to buying land or property to eventually develop into a commercial space, would you finance with a commercial loan, or would you have to purchase with a conventional, then refinance to commercial?
So that's a good question. I'm imagining the scenario, and let me know if I got this right. So like, let's say you're buying a property that has a duplex on it. It's zoned for up to 10 units and you intend to redevelop into 10 units. Yeah, you can acquire with the conventional 1 to 4 unit loan, whether it's, I don't know if you do owner occupied or an investor loan. I mean, in theory, you could live in it and then move out and redevelop it to get a lower rate. But yeah, you could do that where you do a conventional loan on the front end and then redevelop the property. Now, technically, there's going to be stuff in those documents that says that you shouldn't be doing that. And if you do, the loans do. But they're never going to monitor you and call you provided you keep making those payments. Not that I'm advocating you to commit mortgage fraud here, but in theory, you could do this. And then once the property is redeveloped, then you could get a commercial loan on that finished stabilized property. Now, the lender's version of events is going to be different, right? That's the house hacking slash, best way to invest to maximize your capital approach. It's kind of sneaky. But the lender's version would be, no, you're going to buy that property with your equity. You're going to apply for a construction loan. And typically you contribute the land as equity. And then we're going to fund the cost of that construction at, typically a rate that's higher than what you're going to find on a permanent stabilized loan, right, to account for the construction risk. And then once that's complete, you would refinance with a commercial permanent mortgage at at a rate that today is around 3.5. Does that make sense? It's kind of convoluted because there's a couple scenarios I covered there, but I'm hoping that makes sense.
Yeah, there's a couple examples we just had with that, right, Nick, where we had a client who had already purchased the property and was in the middle of developing it, right? And he wanted to just have you look at what he currently had in place and maybe what his future options are once the project was complete.
Yeah, that's right. The key thing to keep in mind, though, if you are going to apply for a construction loan, it's really important that you establish that loan first. Because once you break ground, the lender has to deal with title risk, which simply means that their lien for the construction loan could be behind a mechanic's lien for people who are working on the property. And lenders don't like that. They like to be in a first position. Again, that's more detail than anybody should be concerned with on a general call like this. But I think the key takeaway here is these kind of nuanced questions require understanding of your situation, which comes from a separate phone call after this presentation. So like reach out to me. We talk about your situation and we talk about what makes sense for you as in your individual situation. Again, just so you understand the typical broker cost structure, obviously I'm working in this industry to earn a living. I don't get paid until I close a deal with you. So for the most part, you can reach out to a broker, get an opinion on what you're trying to accomplish, and they can give you basically free advice on how they see it making sense. And then you can take that advice and run with it and either try to do it yourself or, work with them later. And then once they get you a loan you're happy with at closing, they get paid their fair share for, the value they provided you.
Awesome. Well, I hope that everyone found value in today's webinar, and we're certainly committed to continuing this kind of educational webinar series. So any feedback, follow-up questions you might have, to continue to expand on this and other topics within the real estate sector. I'm looking forward to your future participation, and we trust that you found some value in today's call. So thanks so much, Nick, for your commitment of time on today's call and in educating people. And we trust that any questions that anyone has, you have Nick's information. We'll follow up with an email as well. And have an awesome weekend.